Hello, welcome into our seminar on the legislation, the tax legislation for 2025, also known as the Big Beautiful Bill at Brookside Tax and Financial. I'm Tony Marlette Jr., joined by my colleague Jeff Corrigan. And today we're going to go through the aspects of the bill that are going to directly affect our clients. Obviously, there's a lot in this bill. This took a long time to come together, and there's certain things that we're not going to talk about. We're just going to go over the things that financially and from a tax perspective best or most affect our clients.
As we best understand it today.
Right, exactly. Exactly. Yeah. And, it's a good point because these are subject to change, even though they say it's permanent. It's really just permanent until somebody else comes along and changes it. So some things that we'll talk about today, like I said, are going to be the ones that we think will impact our clients the most. Things like locked in income tax brackets, a larger standard deduction, a senior deduction, the SALT tax exemption, the child savings account, estate tax exemption, and some new deductions and an update to the child tax credit. So a lot of what we do, obviously, we do financial planning. These are things that we've been talking to our clients about, Jeff, for a few years now. I know when we do taxes, we talk to people about what their bills, what their brackets could look like for next year. And we've received a fair amount of calls on this.
Definitely.
It's only been law for about a few weeks now. We've received quite a few amount of calls and questions about this.
Right. And that's what prompted us to get on here and talk about it, because a lot of people are very uncertain. They're like, what does this mean to me in my situation? And it's really going to impact a lot of people when you really look at the overall changes that are happening, even though a lot of them actually came into effect back in 2017 when the first bill was passed. I'm not sure. Does that seem like a long time ago to you, Tony? 2017?
It's strange because it seems like I can't ever really imagine the standard deduction, for example, going back to the previous level, having it be cut in half. And that's really what would have happened if this bill didn't go through.
Exactly. Yeah. When you think all the way back then, it was $6,500 or something,
right?
And then double that for a joint, and then all of a sudden everything doubled. So it changed the whole game, and
it really, definitely did.
And it pushed a lot of people away from itemizing because the standard deduction jumped so high. So fortunately, all the things people used to take into consideration, your mortgage interest, your taxes, and charitable and all that, it just wiped it out. It made our job easier at the end of the day.
Absolutely. Well, I think it made most people's, even if you're if you're not preparing taxes, I think if you're filing taxes, it made your job easier because who wants to track all that stuff?
Right. Exactly.
So if we'll get started here on the biggest thing we talked about was the standard deduction. So right now the higher standard deduction is going to be the law again until it gets changed sometime in the future. It does not matter if you itemize, nothing's going to change. So the standard deduction is a deduction that everybody gets that essentially reduces your income for tax purposes. And like we said, I think that was the biggest impact of this was, preparing taxes this year, 2025 for tax year 2024. We weren't sure what the standard deduction was going to be for next year. And this solved it and said, okay, we're keeping those rates and those are going to continue to increase for inflation.
Right. So then the biggest thing, at least a lot of our seniors are talking about now, is the new, what did they think at first? Social Security wasn't going to be taxable anymore. We've heard that for about a year.
Right.
And we always talk amongst ourselves, like, how's that going to happen? How is that possible that they can just not tax any of it? Well, in the end, of course, it was not 100% deductible. What they did is for anyone 65 or older, you just get basically an extra deduction of $6,000 for a single person.
Right. So $6,000 per person. So that's $12,000 if you're married filing joint. And these are subject to phase outs, obviously. If you have earned income, if you're single at $75,000, or if you're married filing joint at $150,000, they phase out at those amounts.
Right. So that's basically what's going to happen. A lot of people are going to get very reduced extra deduction, or maybe not at all. So
Right.
in the end, what it all comes back to is thinking they're not paying tax on any of it, and we'll see how it all works out for most people.
Right.
They didn't change the senior deduction; that's still the same. You get $2,000 if you're single, an extra deduction, or $1,600 per person if you're married.
Right. And I think the important thing to take away from this, like you said at the very beginning, Social Security is still subject to taxes. It is still going to be taxable. You do get the extra, the enhanced standard deduction. And when we've been running simulations for people on this, it actually looks pretty good, as best we can anyway.
Sure, absolutely. When we look at it, I mean, I was kind of surprised in a few of them that I ran how much of a difference it was actually making in the overall situation. But again, you got to be 65. So, you have to think about the people that take Social Security early, if they take it 62 or they have maybe SSDI, the disability, they're going to get nothing.
Yeah, good point. So this is not a standard deduction for Social Security. It's 65 and over, whether you take Social Security or not. So if you're 67 and you have not filed yet, you're still going to get this.
Correct.
Likewise, if you're 62 and you have filed, you're not going to get it.
Exactly.
Yep. And then one thing too that is in here that doesn't necessarily impact Ohioans as much. We talked about obviously the standard deduction. There's a lot made in the news about the SALT cap and the SALT deduction. I don't think this affects people in Ohio as much. The higher income states, New Jersey, New York, Connecticut, Massachusetts, Illinois, those are the ones that really benefited from this. But the SALT deduction now has a $40,000 cap,
which is
up until
quite a jump when you go from $10,000 where we've been stuck in for all these years. And that's why it really wasn't enough for people to get over that threshold to be able to itemize. When you bumped up to that, and like you said, though, a lot of people here in Ohio, we're not really looking at those kind of property taxes. So it's going to affect, fortunately or unfortunately, outside of Ohio, a lot more than here.
Yeah, and you still have to be able to itemize for it. So if you're talking about taking advantage of the SALT tax, the state and local tax deduction, you have to itemize on your taxes, meaning all your itemizations combined have to be higher than the standard deduction. You want to take whichever one's better, which in most people's cases is still going to be the standard deduction.
Yeah, because you're pushing over $30,000. So you really have to have a lot of taxes that you're paying, or, in other situations, maybe you have a lot of medical expenses or a lot of mortgage interest. So it's still going to be a tough hill to climb.
Yeah, for sure. And in Ohio, we don't have those type of local tax. Well, we have local taxes, obviously, but they're not particularly high like some of the high tax, high income, cost of living states throughout the country.
Right.
What about the estate plan? What changed with that?
So that jumped up drastically. So for this year, actually starting next year, anyone over 15, your state tax deduction is going to be $15 million. So we're not going to see that affect a whole lot of people. And then there's $30 million if you're filing jointly, if you're filing together. So again, they drastically increase these over the years. Right. And it's going to cause a lot of people to not have to worry about any kind of estate taxes upon death, which is a good thing. I mean, really, you worked your whole life to save all the money. You're giving it to your loved ones, and then you get hit with a tax on the way out.
Sure. Yeah, no, that's a good point. This is a lifetime maximum too. So 15 million to single, 30 million joint over your lifetime, as far as what you can actually give or what you can gift. Sure. If you go beyond that amount, and there's yearly amounts affiliated with this too. If you go beyond that amount, you simply file an estate tax return.
Right. So you'd file. Yeah, we get a lot of clients that ask that. Maybe they gave their children some money to help them buy a house or whatnot. So a lot of people think that if you give money to your kids, you're going to pay tax. Well, that's not the case, because there is an annual amount that you can give without even worrying about it. And if you do go over that, then all you do is, like you said, if you file the gift tax return to say, okay, I exceeded my limit this year, but it's still not causing you any tax or the recipient any tax.
Right. Yeah. Yeah. Some people may have heard too about there's quite a few things in here that do impact kids. One of them is a child savings account. These are also being called Trump accounts. But essentially what this is any child born between the years of 2025 and 2028 can open an account up to and fund it. It can be funded for a total of $5,000 per year, and the government will kick in $1,000 for each child. Now it's
Basically, free money. I mean, so there's no reason not to take that, without a doubt.
Right.
Now, what happens after that's going to be a whole nother ball game. So the nice thing I see about it is that you don't have to be working. So for a lot of people that want to open up like IRAs for their children, well, if your children are 6, 7, 8 years old, they're obviously not working, so you can't. So this is one thing you can take advantage of and at least get the account established. Then maybe pass the hat around to your family. Anybody want to contribute to it? Because you can put up to $5,000 a year in there. So why not? Why not?
Yeah, great point. And it's tax deferred. So you get the tax break on it. It grows tax deferred. And you have to use it for a qualified withdrawals, meaning you have to use it for what it's intended for. Sure. So there's a list of things, right, that you can use it for. Otherwise, you end up paying capital gains tax on it, which could be advantageous, disadvantageous, whatever it may be. It turns into a standard brokerage account at that point.
Right. And the key is, you have to have it for what? You can't touch it till you're 18 years old. So there are different age parameters on when you can touch it, when you can take it out, whether it be for a home purchase, for education, or even starting a business. So it is a way to try to build some money up for whatever you decide to do down the road.
Right.
And then again, you'll have the capital gains treatment on it. So instead of paying ordinary income on all of it. So there are some benefits to it. Now, you still have to take a step back and say, is this appropriate for everybody?
Right.
You read a lot of the stuff out there and they're saying, really, is this necessarily better than a 529 plan? Or if your kids are working, is it better than setting up an IRA? So everyone's situation is going to be different. So you kind of have to take a step back, look at it and see what makes sense.
I think the biggest thing that would differentiate it for me would be the free money that they're giving you, because the tax breaks, you're right, can come in the form of an IRA or a 529, but $1,000 is $1,000, and your company can contribute to this. You can have outside parties contribute to this as long as there's no more than $5,000 per year that is total contributed to the account.
Right. It's a shame they were just a couple of years too late for you, huh, Tony?
I was just thinking, I was like, I don't know. You said a 6 or 7-year-old isn't going to have earned income. I don't know. Maybe mine will. There's still time for that. He can file taxes with us.
They still have paper routes out there? I'm not so sure.
Lemonade stands, right? Exactly. And then there's some other deductions too, in the form of, we heard a lot in the news. What about all this about taxes and tips and overtime?
All right. That was also a big thing that everybody thought that, we're going to wipe our hands of this, not have to pay tax on any of our income anymore. Well, of course, in the end, there are limitations as there is on everything out there. So the tip income, you will get a deduction of up to $25,000 of it will be excludable. My big worry or concern is, how are they going to track all this? How about for the people that are Uber drivers or Lyft drivers? Or obviously you're paid in different ways. You're paid X amount of dollars for the drive, and then you're getting paid tip. So it's going to be interesting to see how these companies track all of this to determine what's actually tip versus what was actual pay.
Right.
Obviously, it's easy in a restaurant. If you're a waitress or a server or what have you, it's easy. They break that up. It's no problem. But so I'm curious to see how that all plays out. Overtime. There is a deduction for overtime, but up to $12,500 for a single, $25,000 for a joint return. And again, it's only on, so if you're getting paid $20 an hour and you're working overtime, all of a sudden you're getting your time and a half. It's only on the difference. It's only going to be on what's over, the extra half, not the actual whole hour of overtime.
And even on the overage, there's still limitations on that. One thing to remember too is these taxes are still going to be withheld on your overtime, not necessarily on your tips, but on your overtime. You're going to get your paycheck, and it's not like your regular time. If we say 40 hours is regular time, is going to be taxed. And say if you work 60 hours, 20 hours of that, you're still going to have taxes taken out of that. What you have to do is claim that as a deduction when you file your taxes.
Exactly.
And those are subject to the income limits too. 150,000 phase out if you're single, and 300,000 for a married joint return.
Right. So I think a lot of people will definitely be able to take advantage of the overtime. It's just, I think their expectation was that all the extra 20 hours that they worked above and beyond 40 was going to be tax free.
Right.
I think that's
right.
the impression I got from people. Unfortunately, that's not the way it is.
Right. Yeah. They said something like they couldn't do the between Social Security and the no taxes on overtime and tips. They were not able to make those changes during budget reconciliation. So maybe they can do it another time, but my guess is this is going to be about as good as it gets.
Yeah, I agree.
For a lot of this. So the nice part about this piece of the legislation is you can do this with more than just one car loan. So if you have 3 car loans out there, you're paying interest on all of it. You can use more than one.
Correct. Yeah. So you'll be able to deduct that interest. And the beauty of it is it's actually an above the line deduction. So, most deductions out there are mortgage interest, charitable. In the past, you had to be able to itemize. The nice thing about this is for these, you're going to get them regardless of whether you have all those deductions to get you over the standard deduction. So be a good benefit for a lot of people.
Yeah, you just have to make sure that you bought the car in the year of the legislation, which is 2025, up until 2028, as of now.
Correct. So yeah, unfortunately, it's not going to apply to prior years, but again, you'll take everything you can.
Yeah, it's up to $10,000, and then I don't know how they're gonna. They declare too that it has to be assembled in the United States. So a lot of cars, 50-60% established in the United States, 40% overseas. I don't know how they're gonna count that.
Right, and then how they're going to report it too. You figure, like most banks out there do for mortgage interest. At the end of the year, they're going to send those statements out. So you got to think that's probably what they're going to do for car interest now. Is everybody's going to get a statement saying how much they paid over the past year. So that remains to be seen. We'll see how that goes.
That's what everybody wants, right? One more tax form.
Exactly.
And then speaking of extra deductions, and you mentioned charitable earlier, you used to be able to pretty much itemize anything that you contributed charitable pre-2017. Then for a little while, they gave it back where, okay, the standard deduction is increased, but you can still take $3,000, I think it was, that you contribute to a charity or that you donate to charity and deduct that. So they threw back in an extra $1,000 that you can do $1,000 to $2,000 for the updated charitable deduction.
Above the line too.
Above the line, right.
That's the nice thing. So you don't have to itemize now, but I've had calls on that too recently, and everyone's like, well, I want to do that now. Well, that doesn't come into effect till next year. So it doesn't even apply this year, but at least it's some kind of benefit, because that was always a complaint, right? Talking to clients saying, I'm donating to charity, and since I don't itemize anymore, I really get nothing for it.
Yeah.
I don't get to do anything, but so something they'll be able to do.
And if I can't get a reduction on my taxes, forget donating, right? Yeah. No, but it's a good thing to have. I think there should be at least something in there. A lot of people will come to us and, they donated $100 a few different times a year. They want to include it. At least if you're doing that, it's not a huge break, but like you said, you don't have to itemize for it. It just gets taken right off the top.
The other thing that's been updated now is the child tax credit. So in recent years, you basically get $2,000 for any child 17 and under. Well, they increased that now going forward up to $2,200. So they bumped that up as well. But there's still income limitations for that too. So if you're a single person, it starts the phase out at $200,000, and if you're a married couple, it's $400,000. So,
yeah, and these are big too. Even if you don't have kids, maybe telling your kids, if you have grandkids, telling them, make sure that they get that credit on it. So this is a credit and not a deduction. I think that's an important differentiation, like you said before too, where it takes money directly off your tax bill as opposed to just reducing your taxable income.
Right. So yeah, if you look back to pre 2017, that's what it was. We got an exemption for our children. So you got to write off, I think it was $3,600 or whatever it was back then. So, which is just a deduction, but you're right. And now it's a dollar for dollar tax credit. So it's going to come right off whatever tax liability that you have.
Yeah.
Crazy part is, why does it stop it when the children turn 17? Why all of a sudden does it drop so drastically?
You're not bitter or anything, right?
No. My last one is 17. So, but it's crazy. It always dumbfounded me over the years. So why did they cut it back? Are kids getting cheper at 17?
No,
It doesn't work that way for me.
They stop mooching off you at 17, right?
Yeah. That'd be something.
So what else in here? Anything else? These were kind of some of the bigger items. And anything else that you think maybe our clients or people out there would be able to take advantage of?
For those out there hunting for an EV vehicle out there, I'm sure you saw it in the news that come the end of September right now, that big $7,500 tax credit is being taken away from everybody. So, I'm sure a lot of people are out there in a mad rush that have maybe been in the market or been looking for them. I think I read about 2 weeks ago, Tesla themselves said that, if you wait too late into late August, then they might not be able to get it to you because you actually have to take delivery. So if you're in the market for a EV, then I'd be hunting right now for it to take advantage of that credit while it's there.
Right. Okay.
But yeah, there's a lot of other changes, obviously, in this bill that we haven't talked about because it's not really going to affect the mass audience here,
right.
But for business deductions for pass-through entities, there's a lot of different things. So what we definitely recommend is, depending on your situation or you want to know what's happening, you want to reach out to us so we can talk about it. And obviously this comes down to a lot more than just taxes, right?
Yeah, for sure.
You want to look at your whole financial situation, depending on your Social Security, depending on what you've been doing in prior years for maybe your IRA distributions or your RMDs. It's going to change the whole game with the extra deduction. So maybe you're paying more in than you really have to, especially if you're making estimated payments or even on the withholding. So it makes all the sense in the world to reach out to us just to let us take a look at it and see.
Yeah, and we're in a unique situation where, we do taxes and financial planning all in the same office. So we have access, a lot of, I'd say almost all of our clients we do financial planning for, we do their taxes. So these are the simulations that we've been running for people too. It's all under one roof. And that's, we take that one-stop approach where, I've been in roles before where, yeah, you're doing the financial planning, but we have to refer out for, estate planning, like a trust or a will or power of attorney, or we have to refer to a tax advisor. We handle it all in-house. Right. So it really benefits you to.
It's advantage. Yeah. You have the whole team looking at the whole approach and being sure that you have nothing to worry about later on.
Yep. All in all, just I think it's probably a fair statement to say that with this bill, tax rates should be lower. Tax bills certainly should be lower, especially if you're over 65. It definitely lower than what we saw pre-2017.
Right. At least for the foreseeable future anyway. So, yeah, again, there could be opportunities that you could take some extra money out of your IRA now and reposition it because of the extra deduction you're going to get. So a lot of different things to look at. So,
yeah, and you may not have to have as much tax withholding too. You could look at it that way.
Yeah. Okay. So, yeah, feel free. Any of our clients, feel free to reach out to us. You can check out our website at www.brooksidetax.com or feel free to call the office for a meeting so we can look everything over. Number's 440-886-3550.
All right. Thanks, everybody. Jeff, thank you.